Good afternoon and welcome to our Lunch and Learn. I'm Camilla Cullinan and I'm delighted to be joined here today with Audrey Lydon and Cian Liddy, where we're going to talk you through the current tax developments affecting individuals and their businesses. We're going to talk you through the welcome changes to retirement relief from capital gains tax, the follow-on impact that may have on business property relief. We're going to talk about some of the changes in the finance bill on agricultural property and interest-free loans. And then we're going to steer into some property measures on stamp duty and land taxes. And finally, we're going to finish up with some discussions on pensions. But getting straight into it, we were delighted to see in the finance bill that was published last week, and as announced by Minister Chambers in his first budget speech, that the government was going to roll back on the planned introduction of a cap on retirement relief that was due to come into effect from 1 January 2025.
This was certainly good news, Camilla. I suppose just to give some context, in the absence of any reliefs, capital gains tax at the rate of 33% is imposed on business owners who wish to sell their businesses or transfer it to the next generation. And currently, business owners who are aged between 55 and 65 can broadly transfer their businesses to the next generation free from tax, free from CGT. So when the announcements came through last year, while it was a welcomed change that the age limit had increased from 66 to 70, there was a lot of concern that there was a cap put on the value of the businesses that could be transferred at 10 million. So thankfully the finance bill last week has now confirmed the upper age limit to 70. Which is positive, and it has also clarified, the imposition of the 10 million cap. So from 1st of January 2025, businesses in excess of 10 million can be actually transferred to the next generation without CGT once the correct box is ticked on the tax return. But there is a sting in the tail because the children would actually have to retain the business for a further 12 years in order to avoid a clawback of the CGT.
Yeah, and I think that 12-year is quite a long time frame for people, and it's going to be difficult for people to maintain records and remember in 12 years' time that they actually have to file a return. But one of the things that my clients have been talking to me about in the last while, in the 2 weeks since it was announced, is whatever about the 12-year time frame, is there stuff that I need to do between now and Christmas? And I think there is. So I have one client in particular who has a dental practice, and the value of that business is about 50 million. So if they transfer that to their son, who's also a dentist, in the next, whatever is left between now and Christmas, 8 weeks or more. 11 weeks, thankfully, 11 weeks, their child would only have to retain the business for 6 years to avoid a clawback, whereas if they do it in January, they're going to have a 12-year period where they have to keep it and additional reporting obligations in terms of filing a tax return for the child in 12 years' time, which, someone may have retired, files could be lost, and who knows what will happen in the next 12 years. So it's quite a significant period of time. And the second client I have actually who is very much interested in these changes are someone who had the first bite of the cherry a couple of years ago, where they weren't entirely certain that the next generation were ready to run the business. So they gave them part of it and thought, well, I'll do part of it before the age of 66. I will see how they go, and on my death I'll leave it in my will to the remainder. And actually they get a second bite of the cherry now, which was great news. So for 2025 we are looking at transferring the rest of the business to the children, because again it'll be unlimited after that date, albeit with the 12-year the 12-year time frame on returns and things, where they thought they were one and done, but now they get to go again.
So certainly some good news in there. I think what we've come across also, as I'm sure you have, Audrey and Cian, in practice, is there's lots of conditions in claiming this relief, and one of the main things to watch out for is that you review the balance sheet of the business or the company that is being transferred, because the way the rules work, say you take a manufacturing company that's worth 100 million, but if the vast majority of that balance sheet is tied up in stock, which may well be the case, and if your chargeable assets, for example, the property that you're operating out of is worth, let's say, 9 million, and you have a share portfolio worth 1 million, and if you have 90 million in stock, well then the way the rules work, only 90% of that business would actually qualify for relief. So it is very important to look at the conditions, open up the accounts and do a thorough kick, because the devil is in the detail of lots of these things.
Yeah. I think in that example, am I right, that the 1 million of shares will cost you 3.3 million in tax?
Correct.
And if we take that example, you have 3.3 million of tax liability, and one of the things that invariably comes up is 3.3 million sounds lovely, but how are you going to pay it and how do you fund it? And that is probably one of the things that actually causes the most difficulty when you're doing these things, because invariably the cash is all tied up in the business. As we'll speak about later on, it's important to your balance sheet test for business property relief that is the case. And then to try and take more money out if you can, there's a tax charge on that. Or do the parents have the money, or with the interaction of a release, actually does the liability go from a capital gains tax one, which is payable by the parent, you get retirement relief, and suddenly it's a CAT liability that you have instead, and the funding needs, instead of going to the parent who currently owns the business, it actually needs to be the children who get the funding.
And obviously for the parent to pass on that funding to the children, there will be a tax cost. You can do free of tax gifts, which is slightly more efficient, but there's still an overall cost, of course. And other things, non-tax things to consider when we're talking about passing on a business. Obviously, speaking back to your example, Cian, of your dental practice, control comes into it, and relinquishing control. The readiness of the beneficiary to take on the business. And then, of course, you've lots of family governance issues to deal with as well, in terms of how the business is going to be run and managed on a go-forward basis.
Yeah, and I think while it's called retirement relief, we often tell people it doesn't mean you actually have to retire, which is true. And, you can still control the business and be active in it. The difficulty is that the extent of that control affects valuation, and, there are lots of, it's a continuum of valuation, how much you actually want to pass over.
Absolutely, and I think valuation is key. Obviously, any disposals between connected parties, is deemed to be at market value. Revenue always have the benefit of hindsight, so it's really important to have a robust valuation on file to support any values. And obviously, then another important factor is minority discount, which depends on the level of control passing. And there's different minority discounts for different tax heads.
And obviously for capital gains tax purposes, we're allowed to take minority discounts into account, but which leads us into the capital acquisitions tax side of the house for the gift or inheritance. You're generally not entitled to a minority discount. But importantly, there is another relief called business property relief, which is very valuable for the beneficiary in receiving the gift or the inheritance of a business.
Yeah, absolutely. Business property relief is key. It's a key relief to consider on the transfer of any asset to the next generation, because in the absence of it, the rate would be 33% as opposed to 3.3%. And again, the devil's in the detail. It's a matter of going through the balance sheet line by line to establish if all of the assets, which obviously is attributable to the value of the shares in the company, that they actually, constitute business property as defined. And I think most taxpayers would sort of expect, if there was holiday homes or investment portfolios on the balance sheet, not to qualify for business property relief. But very often, cash can be a bone of contention, really. And, Revenue's stance in recent years is that the starting position is, does this actually all qualify? Probably not. And the onus really is on the taxpayer to be able to demonstrate that this cash is needed. Obviously companies can be retaining cash, for future expansion, rainy days, etc. But very often we'll put, cash on maybe deposit. So that in its own right doesn't mean it's, it's not business property. But I think it's really important for the company directors to probably minute in board meetings why levels of cash are being maintained at a certain level and why it's needed for the business is definitely important. And I suppose, business property relief is so important because, again, in the absence of business property relief, you're looking at CAT at 33%, Whereas if business property relief is available, it reduces the rate to 3.3%. You know, so it's really important to to make sure that the evidence is there to support a claim.
And I think there's been some helpful decisions from the Tax Appeals Commission recently that would suggest that it is absolutely allowable that there is some cash built up in a company for future business or expansion purposes.
That's right. In that particular case, I think Revenue took the view that, you know, only 25% of the cash is allowable, and that was their starting position. But I think what that case, you know, the determination in that case sort of showed that the cash doesn't have to be used 24/7, you know, actively in the business, but that it's there, but it's been held for business purposes.
Yeah, I think the assessment of that I always find is very bespoke. You'll have some businesses where the nature of their receipts are it's a lot of cash up front and you pay it out for 12 months, and then others are the easy one is the one that has a regular receipt of cash and regular turnover, and you can stand over pretty easily. Yeah. I suppose the other thing that came out in the budget that affects that is that relief works by reducing the amount that is taxable. And one of the things that got coverage before the budget announcement was that the CAT thresholds, and would they be increased? So happily they were, but the phrase rising tide lifts all boats does not apply, unfortunately. So when people hear that the threshold has gone up by 65,000, everyone naturally enough says, that's great, I can give another 65,000 to whoever the beneficiary is. And I have a couple of unfortunate instances where that is not true. So to take my own family as an example, which I haven't, but if I had given my son 400,000 before, by now, actually the increase in the CAT threshold makes no difference to him. So even though he would have paid tax on that 65,000 already, getting a new gift won't help him. He won't get a refund of the tax. So that tax is done, and the increase in threshold doesn't help, which can come as a shock to a lot of people who hear all the good news stories and say, here I go, here's another 65,000.
I suppose on the flip side, if you'd given him 350,000 so far, he'd still have 50,000 left to utilise.
Yeah, albeit again, everyone expects 65 and it's only 50. So you just have to be careful exactly how the mechanics of these things work. Yeah. And also how much you have, I suppose, unwittingly used up on these things, which can happen a lot with the bank of mum and dad.
Which leads to the point, actually, when you come, if somebody has paid capital gains tax, for example, if the business didn't qualify in full for retirement relief, that capital gains tax can be available to offset against the CAT on the other side. But unwittingly, if you haven't used your threshold already, some of that CGT credit might be wasted. So there is a little bit of just planning in terms of, are you planning on using that CA3 threshold on other gifts, and just the timing of that gift, should it be before the transfer of a business?
Yeah, absolutely.
Yeah. Sticking with CAT, there's been a lot in the newspapers and the media coverage over the past few years on the bank of mum and dad and interest-free loans or low-interest loans, especially in the times of rising property prices, where parents have funded property acquisitions by their children by way of a loan. And I know last year there was changes introduced. There was new reporting requirements where if you had interest-free or a low market rate of interest, you had to report that to Revenue if no interest was paid on the loan within 6 months. There's been some changes on that as well. There has,
yeah. Again, the loans from the Bank of Mum and Dad had lots of coverage over the last few years, so again, the finance bill last week has sort of modified the changes and has extended the provisions to also sort of catch low interest loans. So regardless of whether any interest is paid, so like under the changes from last year, if you could have had a low interest loan, and even if like a nominal amount of interest was paid within 6 months of the calendar year, then that loan didn't have to be reported to Revenue. Finance bill last week has modified that now and has said that any loans where market rate interest is not applied on certain loans from close relatives and companies, and indeed companies owned by close relatives, then those loans will have to be reported to Revenue.
It's worth noting that Revenue accepts that the market rate of interest on such loans is the best rate that the lender could get by placing those loans on deposit.
That's right, and I think it's really important as well to be able to evidence that. So the gift, so for the free use of money or the cheap use of money, the gift is deemed to arise on the 31st of December each year. So certainly, taxpayers should be reviewing the best available rates, typically from the pillar banks, keeping, even preparing a spreadsheet, calculating the interest, and keeping a copy of the evidence of the best available rate.
So I think between here and year end, we should really be looking at the terms of all of these loans and just seeing what needs to be documented, what needs to be evidenced, and does interest need to be calculated, because perhaps there is no CAT liability because you're a small gift exemption of 3,000 per annum, or maybe you haven't used up your threshold, so there might not be a CAT liability, but you need to be careful. Just because there's not liability, you might still be forced into reporting.
Yeah, that's right. So definitely the recipients of these loans need to, consider their compliance obligations. And I suppose it's also probably worth pointing out that, even if the loans, perhaps market rate interest is going to be imposed on the loans, they don't necessarily have to be paid within the year, that the interest can be accrued and can actually be repaid. Can be paid. The interest can be paid over in the future on the final repayment of the loan. And in that case, there's no reporting requirement.
In other things, CAT, and one that is close to my heart, is agricultural relief, one of the most valuable reliefs I think there are. There has been a condition for a long time about the beneficiary of a gift or inheritance of agricultural land, which the relief firstly reduces the taxable value by 90%, as the three of us are well used to telling everybody. But I think the condition has been that for a beneficiary, they need to either have a relevant qualification, which is effectively a green cert, and farm the land themselves. They need to spend at least 50% of their working time farming the land, or they need to lease it to somebody who meets one of those two conditions, and those have to be maintained for a period of 6 years after the gift, which can be great fun entirely to watch out for. And in one of the changes that was brought in last week, that has now been extended, so that condition now equally applies to the donor. What that means is the donor now needs to own the land for 6 years and have a green cert for those 6 years. They need to lease the land to somebody for 6 years prior to the gift who meets the conditions, or they need to spend at least 50% of their own normal working time working on the land. So in my house, where we have that, one of the things that we thought about doing actually was that we could bring in a farm manager when my dad passed away. And when you look at that now, actually, that would mean that we would not qualify for relief, whereas if we leased it out to somebody else instead, it would qualify for relief, whereas you kind of think that commercially it is the same thing. So like any of these things, the intricacies of the relief and how it applies can be quite difficult.
And that's probably common practice, Cian, as well. You'd have a lot of families where you have mum and dad, maybe dad has passed away, you've got an elderly mum, and they've literally got maybe a local farmer to come in to manage the farm, and now all of a sudden the relief is no longer available. Yeah,
exactly. And it's going to make a huge difference to families, and that the maintenance of the farm through the generations, which is really what this relief is aimed at. I think one of the other things that's making a big difference to farmers, if we stick on those for a minute, is the residential zoned land tax, which is a bit of a mouthful. So that tax, for anyone who's not aware, if you have a serviced land that is zoned for development, it's a 3% charge per annum if that site effectively is not being actively developed for housing. So there was quite a lot of uproar when this came in, and the Finance Bill has now introduced this new exemption clause where if a farmer applies to the council and asks for the land to be unzoned again, that they're asking the council to look favourably on that application so that the tax doesn't apply. But I do kind of feel a bit like it's give with one hand and take with the other, because in September they also published a zoning value sharing bill, where you have a zoning decision that increases the value of the land, 25% of that increase will now be a planning levy. So if you have a farm that's on the outskirts of a town, and that's why it's in scope of the RZLT, you have your choice of, you pay a 3% charge every year, and your zoning, your planning levy is kind of built in, or you take a chance and say, actually, I'll get it unzoned, knowing the likelihood is the town is going to expand, and in future you're going to have a zoning decision where the 25% may be a bigger number. So while the 3% exemption may seem the obvious and natural thing to do, in the long run, it may not make sense.
Definitely crystal ball grazing. Definitely crystal ball grazing required there. There was other property things that, announced in the finance bill as well. Residential property being one that wasn't flagged at all, whereas going forward, well, with effect from the night of the budget, any residential property with a value of over 1.5 million, that value over 1.5 million is going to be now subject to stamp duty at 6%. So that's going to really impact houses with a value of over that amount, and could in due course impact actually the value of those houses.
Absolutely, yeah. And also obviously the stamp duty rate on bulk acquisitions of houses has increased from 10% to 15%. And I suppose it's, you know, sometimes when people think about bulk acquisitions, they think maybe developers acquiring an entire housing estate. But it's actually a lot more, far-reaching than that. You could also have family businesses, maybe, you know, the investment arm that might be, you know, speculating in property, acquiring numbers of houses. So if they actually acquire more than 10 houses within a 12-month period, then they're within this increased rate. And
that's a rolling 12-month period, so it means that you have to be constantly reviewing, and in terms of your investment decisions, constantly reviewing and analysing, are you coming close to that threshold?
Yeah. Absolutely.
And I think that is the way people look at these things. It's in a private client, family office type world, that is an investment strategy decision, and you decide, well, we would like to acquire these properties, and the rent roll will form annuity income. It'll give us all income in retirement, all that very valid and sound reasoning, but yet you can get caught by this tax accidentally. I think one of the other places where that type of investment strategy piece comes in is in pension planning. So over the last 12 months or so, we've all seen it. A lot of our clients have had their, I suppose, one-person occupational schemes through their employer company being wound up as part of changes in the pension landscape, and now they're in PRSAs. So everyone has moved to PRSAs over the last 12 months, and now in the finance bill last week, we have a new change to the way PRSAs work. So for a PRSA, an employer contribution going forward is going to be limited to the same amount as 100% of the employees' emoluments from that company. So if you were in the one-man occupational scheme, like you probably were 2 years ago, the longer you worked in the business and built up a length of service and remuneration amount, you had a cumulative funding capacity that was building all the time, and it didn't really matter when you made the contribution. You could build it and make the contribution when you had the cash to do so. What this really has done is said, well, you have to assess it on an annual basis. So we don't really get that cumulative piece. You can't build up your funding capacity and say, we'll do it. You actually have to make the contributions year by year, which is going to be challenging for lots of people, and particularly in cases where the income is lumpy, because you pay out big bonuses when deals are landed, things like that. Like the income just does go up and down a lot.
And even for startups and entrepreneurs going into new businesses, and it takes a while to build the business, it's going to have an impact there as well.
Yeah. Time.
And it's sort of counterintuitive, even with the whole policy of the government is to actually increase the funding levels of private pensions, and now it just seems that certain employers are going to who just don't have the cash flows to support large pension contributions now, unable to do a catch up in later years.
Yeah. Ironic in the same week that the auto-enrollment pension scheme was launched.
Come into effect next September, of course.
Yeah.
We started with some good news on the retirement relief side of the house, which was welcome, albeit with a sting in the tail. There has also been an announcement that the standard fund threshold for pensions is going to increase over the next little while, which is also very welcome.
Yeah, that's right. The standard fund threshold is going to increase from 2 million to 2.8 million between now and 2029, with annual 200k increases. And then the intention is from 2030 for it to increase in line with wage inflation. And which is positive, and also I think the amount at which you can actually take out your pension, either tax free or at 20%, remains the same at 500k. But again, that could be reviewed in the future.
Yeah, and another area that we're hoping will be reviewed in the future. So obviously, people invest in different portfolios and funds. And Ireland has a good base for these funds and asset management. And last year there was a consultation on the funds industry, and the taxation of personal investments formed part of that. And helpfully the Minister announced that he had a funds team that had been brought together, and they were hoping to report on that over the foreseeable future. So we're hoping there'll be some good news in there in terms of the taxation of personal investments. As we hit into income tax and compliance season, there's a huge administrative burden to determine the tax implications of the various investments that people have invested into. So hopefully there'll be good news down the line on that. But I think the message from today is that the devil is in the detail. There's lots of good news, but there's lots of complexities, and we just need to be really careful of the sting in the tail. Obviously, if you'd like to discuss any of that, please do get in touch with us.